As we progress from understanding offer instruments and lease structures into the financial dimension of commercial real estate, this section explores the key financial concepts that underpin investment evaluation, acquisition decisions, and long-term profitability. Commercial real estate differs greatly from residential real estate in financial structure because it involves larger capital commitments, complex income streams, and a broader array of financing and taxation factors. Real estate professionals in Arizona must be able to interpret property tax systems, financing mechanisms, and return metrics to provide sound advice and ensure compliance with state law and professional standards. One of the first and most fundamental financial elements in commercial property ownership is the property tax rate. Property taxes in Arizona are governed primarily by Title 42 of the Arizona Revised Statutes, with local assessment and collection administered by county assessors and treasurers. Property tax assessments are based on the property's full cash value, FCV, and limited property value, LPV, as defined in ARS Paragraph 42, Chapter 13. The LPV is used to calculate property taxes and is capped at a maximum annual increase of 5%, providing stability and predictability for property owners. For commercial properties, the assessment ratio, the percentage of LPV used to determine taxable value, is generally higher than that for residential properties. As of 2025, most commercial properties in Arizona are assessed at 18% of LPV, compared to 10% for residential properties. This distinction significantly affects the tax burden and must be factored into any financial analysis or lease structuring. For example, a retail center in Maricopa County with an LPV of $1,000 would have an assessed value of $180,000. If the local tax rate is 10%, the annual property tax would be $18,000. In a triple net lease, the tenant would be responsible for this cost, whereas in a gross lease, the landlord would absorb it. Understanding this difference allows agents and investors to accurately evaluate operating expenses and net operating income, NOI. The next major financial component is financing, which plays a pivotal role in commercial acquisitions. Common types of loans include conventional commercial mortgages, small business administration, SBA loans, bridge loans, and commercial construction loans. Conventional loans are typically issued by banks or credit unions and require substantial down payments, often 25% to 35%, along with strong credit worthiness and demonstrated income stability. SBA 504 and 7A loans, backed by the U.S. Small Business Administration, provide more accessible financing options for owner-occupants purchasing or improving commercial real estate, often with down payments as low as 10%. For investors developing or repositioning properties, bridge loans offer short-term financing to cover acquisition or renovation costs before long-term financing is secured. Construction loans in Arizona are not governed by a single statute, but are generally subject to the Deeds of Trust statutes and as dispersed in phases are draws as construction milestones are completed. Real estate licensees involved in such transactions must ensure clients understand the lien priority and risk factors associated with construction financing, as Arizona's mechanics lien laws grant contractors and subcontractors enforceable rights if payment disputes arise. In commercial investment, understanding the metrics for measuring returns is crucial. Unlike residential properties, which often rely on appreciation and simple rent comparisons, commercial properties are analyzed through income-based approaches. The most common financial metrics include net operating income, NOI, capitalization rate, cap rate, cash-on-cash return, and internal rate of return, IRR. NOI represents total income minus operating expenses, excluding mortgage payments and depreciation. It measures the property's profitability from operations alone. For example, if a property generates $250,000 in rental income and incurs $80,000 in operating expenses, the NOI is $170,000. A Gross rental income operating expenses applied to your example. NY, $250,000, $80,000, or $170,000 gross rental income. GRI includes all income generated by the property before expenses, typically included in gross rental income base rent from tenants. Additional rent reimbursements, such as common area maintenance, KM, property tax, reimbursements, insurance reimbursements, percentage rent, retail leases, parking income, laundry and vending machine income, storage unit fees, late fees, if treated as income. Other tenant-paid fees related to occupancy not included in gross rental income security deposits, unless forfeited, loan proceeds, owner contributions, sales tax collected on rent, one-time insurance proceeds, capital contributions, related distinction, exam safe, potential gross income, PGI, income assuming 100% occupancy, effective gross income, EGI, PGI minus vacancy and credit loss plus other income. Operating expenses are the ordinary recurring costs required to operate and maintain an income-producing property, excluding financing and capital costs. Common operating expenses, property taxes, property insurance, property management fees, repairs and maintenance. Routine, non-capital. Utilities paid by the owner, water, sewer, trash, electric, gas. Common area maintenance, CAM. Janitorial and landscaping security services, HOA, or condo association dues. Advertising and leasing costs. Legal and accounting fees. Operational, not transactional. Licenses and permits, administrative expenses, pest control reserves for replacements, if included in underwriting. Not operating expenses, mortgage principal and interest debt service, depreciation income taxes, capital expenditures, CapEx, roof replacement, major HVAC replacement, structural improvements, leasing commissions, often treated separately, tenant improvements, capital in nature. Cap rate is derived by dividing NOI by the property's purchase price or market value. In this example, if the property sold for $2,000, the cap rate would be 8.5%, $170,000, $2,000. This metric helps investors compare returns across different properties and market sectors. In Arizona's 2025 market, typical cap rates range from 5% for high-demand retail centers to 9% for industrial or rural commercial assets. The capitalization rate, cap rate equation is cap rate net operating income, NOI, purchase price, or market value, cash-on-cash return evaluates the annual pre-tax cash flow relative to the amount of cash invested. If an investor puts down $500,000 and earns $50,000 in annual cash flow, the return is 10%. This measure focuses on actual liquidity rather than paper appreciation. Finally, internal rate of return, IRR, incorporates the time value of money by measuring the total rate of return expected from an investment over time, considering all future cash inflows and outflows. While more complex, it is the gold standard for evaluating multi-year investment performance, especially in projects involving refinancing or property disposition. Arizona courts have addressed the importance of transparency in financial disclosure in commercial deals. In Ness versus Western Security, Life Insurance Coerce 1980, the Arizona Supreme Court held that all material facts affecting a party's financial decision must be disclosed in real estate investment transactions. This reinforces the broker's duty under AAC R4 28-1101B to disclose any information that could materially affect the client's judgment regarding a property's financial performance. In Ness vs. Western Security Life Insurance Co., the Arizona Supreme Court addressed whether an insurance company could avoid liability by relying on technical policy provisions when its own agent had knowledge of facts allegedly violating the policy. The insured applied for life insurance, and the insurer later attempted to deny coverage based on alleged misrepresentations or policy conditions. The court held that knowledge of the insurer's authorized agent is imputed to the insurer, and an insurer may be stopped from denying coverage when it issues a policy with knowledge of facts that would otherwise defeat coverage. The case stands for the principle that insurers cannot accept premiums and issue policies, while later relying on undisclosed technical defenses inconsistent with their agent's knowledge or conduct. Real estate professionals must also be mindful of fees and compensation structures. In commercial real estate, commissions are often negotiated as a percentage of the total lease value or sale price. Unlike residential brokerage fees, which are more standardized, commercial commissions vary depending on property type, transaction complexity, and market conditions. Ethical practice requires full disclosure of any fees, referral arrangements, or compensation from third parties under ARS. Paragraph 32, 253. Review summary. Understanding property tax implications, financing structures, and performance metrics is essential for competence in Arizona commercial real estate. Property tax assessment differences between commercial and residential properties can dramatically affect operating expenses and returns. Knowledge of loan types allows licensees to guide clients towards suitable financing strategies. Finally, metrics such as NOI, cap rate, and IRR provide objective measures of investment success. These concepts ensure that licensees operate with financial literacy, accuracy, and integrity in advising clients on commercial investments. Discussion prompts. Why is net operating income, NOI, important when evaluating a commercial property? Answer. It reflects the property's profitability from operations, excluding financing costs, and serves as the foundation for determining value through the capitalization rate. What is the primary difference between a conventional commercial mortgage and an SBA loan? Answer. Conventional loans require larger down payments and stricter qualifications, while SBA loans provide more accessible financing for owner-occupied properties with lower down payments. Why do commercial properties typically have higher property tax assessment ratios than residential properties in Arizona? Answer. Because Arizona classifies commercial properties as income-producing assets, subject to an 18% assessment ratio, compared to 10% for residential. Closing remarks. The financial knowledge of a commercial real estate professional extends far beyond closing transactions. It involves guiding clients through the fiscal complexities that define profitability, sustainability, and compliance. From understanding property tax structures to evaluating investment metrics, real estate professionals in Arizona serve as advisors, educators, and protectors of their clients' financial interests. Competence in these areas not only strengthens individual credibility, but also upholds the professional standards required by the Arizona Department of Real Estate and State Law.